Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, with our mid-year call, and there's been a lot going on the first 6 months of the year. And a couple of things that we might mention that we see themes is that we really feel like interest rates are going to remain higher than people think for the next few months, and I think that would surprise most people. Housing has gotten a lift. We'll go into that a bit in this call as well. You'll see how the economy still remains weak and is actually getting a bit weaker. We still feel like earnings expectations are too high, too optimistic, and speculation remains very high. It's interesting to us that speculation is almost as high as it was at the end of 21, but in a different way. So let's take a look at the economy right now. If you look at the leading indicators, and you can really talk this stuff down if you want to, but the leading indicators have been a very, very good source of what was going to happen in the economy. And we've had leading indicators turned down for many months now. We're getting to the point though, once you get around 14, 15 months past the time when the Federal Reserve started raising interest rates, that's where it starts to really show in the economy. The second thing is, and people ask us this all the time, well, where's everybody spending money? Where are they getting the money? What's going on? The airports are full, this, that, and the other. And I say to them, look, you're at the end of the free money. And if you'll notice in this graph how the various quartiles, lowest quartile, people didn't have any money, particularly second, third, and fourth. If you'll notice how they spent the money, spent the money, spent the money. So now that we're down to the third quarter of 23, there's very little of that money left. And so what you're seeing now is running basically on empty, but it was dealt the blow from the past 2 years. The other thing that's happening is retail sales are declining. They really are showing you what the consumer's thinking about at this point, because we're starting to see various retail companies really show up and say, hey, we just don't have the earnings right now. The other thing that we're seeing is continuing claims for unemployment are rising. Now, yes, you will have these little crackbacks like we just had, but generally, if you look at a 4-week average, they're increasing. They haven't really gotten to a break point yet where people are super worried, but they're started that direction at this point. Another thing, and this is only the first 4 months of this year, but we're already up to 236 bankruptcies and in corporate bankruptcies. And if you look at 2010, which was the biggest year, it's 325, but we're only 4 months into the year. And we've said all along that a lot of these companies probably wouldn't make it through 23, and it looks that way still to us at this point. So let's talk about housing, and there's a lot of talk about housing. Well, it's bottom, it's coming back, it's this, it's that, and the other. I think there's some reasons that you're going to see why particularly new homes, okay, are doing better. But first of all, if you just take a look at the Case-Shiller price index for real estate, the home prices have they were at all-time really stupid highs over the last 2 years. And it's probably a once-in-a-lifetime thing for the people that got involved in this whole thing, but we see some trouble over the next few years in this area, even though people won't really talk about it at this point in time. So let's just look at one thing. If you look at the average mortgage payment, okay, the median, I should say, from just 2 years ago, all right, it's doubled. And it's almost 50% of after-tax income on the median. Well, that is about as full as you can get and make a payment. And think about it like this, if you have 2 people working, which we have a lot of families that have 2 people working, they cannot afford for one of those people to lose the job. So that's one thing. The other thing is people, and this is what we're seeing in existing home sales. Existing home sales are declining. There's a reason they're declining. Number one, we have a whole group of people that are not moving, okay? And you can see this has been a declining trend for a number of years, but what's happening is, particularly with working remote, et cetera, we have the least amount of people now that are really relocating for the job. So if you look at pending home sales, now this is sort of a leading indicator on residential real estate. It's still off 20% year to year. Yes, it ticked up a bit in the last month and a half, but if you look at it, it's telling you something about the longer term at this stage. The other thing that's happening, and this is why new homes are moving more. First of all, if you just look at the cost of materials going in new homes, they've had a dramatic decline, and that's helped builders get that entry-level home at the right price, and it's made an impact. More people can buy that home for a price because the materials have gone down, and so they can still make their spread with less cost. I'm talking about the builder here. That's had an impact on new home sales, but not on existing. So you'll see, when you see these numbers on starts, single-family starts, multifamily starts in the real estate market, you'll find that single families are not going anywhere, but multifamily apartments keep on going higher and higher and higher. Now, where they take this to, we don't know, but we do think that where it won't be like commercial real estate, as far as the office market, they will get to a point where they'll saturate the market in time, at least for a period of time, as far as that goes. So I would say to look at it on that count, we just think there's some factors in the real estate, residential real estate, that people have to stop and think about here. So in the bond market, if you look at it right now, at the competitiveness of Treasury rates, it's really interesting. I mean, it's been a long time since we could get 5.3, 5.4% on a U.S. Treasury short term. I mean, no risk. 3 months, 6 months, 1 year. That in itself is something where people are looking at that and saying, I'll take that. The other thing that's happening is, I'll give you this equation here, but if you look at the earnings yield on the S&P 500, what you do is you take the earnings and divide it by the S&P price. Okay, that currently is about 5% in our opinion. Also, we compare that to the U.S. Treasury, which is 5.3%. So when you look at that, which one do you want to own that has the least risk to it? Well, obviously it's a short-term Treasury. The other thing that's happening, and Financial Times ran this, but if you look at corporate bonds, Treasuries, and the earnings yield all together, okay, and you say which one do we want to own, you'll find that the Treasury is the least risky for about the same return. So one of the things the Federal Reserve looks at, and I'm not necessarily agreeing with this, but they key off of the personal consumption expenditure number, all right? They don't use the consumer price index quite as much. But if you take the consumer price index and this number, they both have about a third is rent and lodging. So you're in a situation where that's a lag indicator, and you know where it'll show up and really push this to a lower level. But it's probably, sooner than later, I would say. But if you look at the PCE number, that tells the Fed that they are not at that 2% or even 3% of where they wanted to be. So they probably will do something in July. Just a guess, but we think there's a decent chance they'd do that. So let's go to the stock market. And I will have to tell you that the speculative juices are flowing as big as ever right now, okay? And that's okay if that's what people want to do, but I just want to give you some facts about what's happening. If you take the top 10 stocks 8 years ago, and this we have this graph really from our friends over at Horizon who do some really good work, but if you take the top 10 stocks in 2015, they accounted for about 17% of the S&P 500 market capitalization. If you take the top 10 stocks now, they count for almost 32%, just 10 stocks of the S&P 500 market capitalization. And if you look at the top 7 technical stocks, the technology, they're almost 28%. One little known fact on these top 7 is this. If you look at their market cap combined, it's almost $11 trillion. And estimates for analysts out there have them selling at about 36 or 37 times earnings. and a 28% average growth rate on these 7 companies over the next 5 to 10 years. You have to stop and think about this. If that really happened, and it could happen, these 7 stocks would be as big or bigger than the entire GDP of the United States. Hard to fathom, but I have to think you would want to factor that in when you're doing some work in this area. One of my colleagues, Scott Budd, did this slide for me, and it makes a lot of sense. We included in our market letter, which is coming out in a few days. It's entitled The Camouflage Market, and we show where these 7 stocks account for most all the gain this year, and all the other 493 are virtually non-existent in terms of numbers. You have to keep that in mind when you start to see, well, the S&P did this and they did that. It's really not the S&P. It's just a few big names right now. So look at where individuals are. And we notice this too. If you look at the blue line, individuals are about as fully invested as they ever were. And that's on the left-hand axis over here that you'll see. They're about as fully invested as ever, which means that the 22 sell-off, which we have not gone back to a new high at this point, has not scared anybody basically much at all, and certainly haven't seen any capitulation. I want to give you a few things to keep in mind, though, about timing and things that go on. In December of 1999, Jeff Bezos, who founded Amazon, was Time's Person of the Year. Stock was $100 at that time. And by the time you got to the 3rd quarter of 2001, that stock was about $6 or $7. Now, if you had timed that right and looked at what was going to happen the next 15 years, yes, you would have made a ton of money. But I sometimes wonder how many people would have had the fortitude to stay from 100 to 6 and back. Probably not that many. The other thing that happens here, and I wanted to give you some insight into some history, all right, and that is, if you look at the biggest stocks that ran the market averages in 2000, the 1st quarter of 2000, these are the prices they were and the declines they have, which were huge. But notice the right-hand column, how long it took for those companies to break even. If you look at that, they average out probably 13 to 14 years. That's a long time for you to be playing in those speculative areas. So as we go forward, this is what we would say as a summary. Number one, our advice would be to stay away from speculation. Let me say this. We are not really saying if you speculate that you're a bad person or anything like that. I'm just saying that's not what we do. Our number one thing that we do for people with money is we start with preservation of capital. And we do not get into this chasing of these big 7, 8 names, buying one-day options, one-week options, that sort of thing. Usually, maybe not this time, but in the past, that's not turned out to work out really well for people. So I'm just saying to you that we are different, and we aren't for everybody, by the way. We press preservation of capital first with growth second. And we wrote a book a couple years ago entitled Your Money Mentality about you need to know yourself, what makes you go in terms of money. I know we know ourselves, and for us, we start with preservation. Secondly, we feel like you can own short-term treasuries now, and you'll have a chance to buy equities later or over time. I know everybody thinks that, hey, everything's fine now, we're going to come right out of this and it'll be okay. It doesn't look like that to us. It looks like it's more of an elongated time. When you go in, you'll have worse problems than probably people expect. Thirdly, patience for us is paramount right now. We have a number of questions about, well, you missed the market, you missed the market. Well, we really didn't miss the market. I mean, we're in stocks. We just have a lot more liquidity right now than we've ever had since 2000. Doesn't mean we're not participating. We're just not participating with 100 cents on the dollar right now, which is the way we try to protect people in case we have one of these situations out of the blue. And the last thing I would say to you, and the press will make you feel this way, that you better get on board, because if you don't get on board now, this thing's going to explode to the upside and you'll completely be left behind. Our point on that, and that's after 40 years of dealing in the market, is that, you know, there's never a last train out of the station. There's always time for you to invest. And if we're going into a 2 or 3 year bull market and things change fundamentally, which they haven't so far, then you'll have time to do that. So our advice is to stay patient. You know, there's time in here, and you're making good money on the treasuries. We're participating in the market, not to 100%, no, but that's okay for where we are now. So I think you have an idea of what we're thinking in here and what's been going on for us in this first 6 months of the year. But if you want more information, certainly give us a call or come to our website, oxbowadvisors.com. So for that, we'll see you next time, and thanks for joining in. Hello everyone, I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.